Hey there, welcome to ACG 2071. These presentations are for you to look at before you get to class. You should probably look at these around the same time that you're looking at the chapter. And the more you understand before you get to class, the more you'll get out of class time, okay? So we're starting here with chapter 12, and the reason why is because it's a nice connection to what you've learned in 2021, all right, in the financial accounting class. So the objectives here, we're going to start out with the 4 financial statements of a for-profit company, then a couple analytical things. We'll look at horizontal and vertical analysis, and these are nice connections to 2071. Then we'll interpret some financial ratios that we use to analyze a company's performance. Okay, and these are like a little bit more advanced, but there's still a really good connection to what we do in 2071, where you can actually do something to affect these ratios. Okay, in financial accounting, you report about them, but in managerial accounting, you can impact the ratio. And then we'll discuss briefly what the impact of big data is on transforming organizations, and then core competencies required of a management accountant. So the 4 financial statements, we've got the income statement, statement of retained earnings, balance sheet, statement of cash flows. Now remember, these are the 4 required statements by all public organizations, okay? These 4 statements, this is what's required. And we'll talk about a little bit about the limitations on what's provided here. So income statement, statement of retained earnings, balance sheet, and statement of cash flows, okay? So what we do in financial accounting is identify financial events and record those using GAAP. Then they're summarized and they're reported in these statements. All right, who are of use to all kinds of users of financial information from an organization. Now, the income statement measures financial performance over a period of time, so it would be for the year ended or for the quarter ended. And it includes 3 things, okay? Just think revenues, expenses, and then gains and losses. Okay, now the difference between these is revenues and expenses relate to operating activities. That's operations, that's what you do in your normal life. Okay, as a company, that's sort of what you're in business to do, in business for. And then gains and losses, these are for non-operating activities. So they're separated because we want to be able to compare one year to another. The statement of retained earnings is a little bit more complicated, and what it combines the contributed capital with retained earnings. So contributed capital came in from people, maybe the owners of the company, all right, or outside investors, which would also be owners. And then we've got retained earnings, and that's retained or saved earnings less any dividend payments. So it's contributed versus earned capital. And the statement of retained earnings shows how net income and dividends affect the financial position. So when you think about this statement, think 4 pieces, okay? So a beginning retained earnings plus net income minus dividends declared equals the ending balance. And that's it. You might want to add something else in here, or you might want to take dividends and put them over on the income statement. No, they all belong right here. Okay, 4 lines, that's what it is. Okay. The balance sheet, this reports the financial position of the company as of a certain date. And you want to think that we've got assets being equal to liabilities plus stockholders' equity. And assets are resources to provide future benefit. Liabilities are debts or obligations to be paid out of those assets. And stockholders' equity, again, is the residual interest or its net assets. Okay, that's stockholders' equity. Okay, that's what's left. After you've got your assets and paid your bills. But there are a lot of assumptions, okay, underneath these numbers. The statement of cash flows is probably the most challenging statement for you to do, because this is based on cash, whereas the balance sheet and the income statement are both done on an accrual basis. So we have, first of all, 3 major sections, all right? Operating activities, investing activities, and financing activities. And operations are related to all income based on cash, all activities relating to earning income based on cash. But what this is, it's going to be adjusted by your current assets and current liabilities. Okay? All right, because current assets and current liabilities are related to operating activities. And we'll come back to this. Investing activities relate to all activities related to buying or selling long-term assets. So investing activities are on the long-term asset portion of the balance sheet. Asset side, only the long-term portion. And financing activities are on the long-term liability side, so long-term liabilities and equity transactions. Okay? And this is a little hard to see here, isn't it? This shows how it shows how the statements relate to each other, but not necessarily how you prepare them. Okay, you want to think that the statement of cash flows provides the company's cash from a prior year to the current year. Okay, that's the statement of the change in cash, and that flows into the cash account on the balance sheet. Okay, whereas for owner's equity, that's going to be impacted by the statement of retained earnings. So that's revenues and expenses from the income statement. This is where your retained earnings come from. Less dividends or withdrawals from the owner affect owner's equity, and then any changes in ownership by owners. Okay, maybe any investments by an owner we go into here. Okay. Now, a couple limitations on the financial statements relate to some of the assumptions underneath it. And the first thing is that we use historical cost. And historical cost can be verified and it's reliable, but it doesn't necessarily represent current value. Okay, especially in periods of rising prices. So if you have investments in stock, the changes in the value of those investments is not going to be reflected if they're long term. And if you have, let's say that you've got buildings, all right, on your balance sheet, that building number reflects the cost, not how much the building is really worth. Okay, it could be worth quite a bit more. If it has depreciated a great deal and it's a mess, then that will be shown. Okay, but not the increase in value. In conservatism, the conservatism principle says that many costs are expensed immediately rather than recorded as an asset. And remember that to be an asset, we're looking for future benefit. So if you're not sure if a cost is going to provide future benefit, then you might write it off. But one of the most important things is to be consistent. Okay, so to do the same things the same way from one period to the next. Our next objective here is to using a horizontal analysis of the balance sheet and income statement, and then evaluate the company using trend analysis. So we're looking at one period to the next. And in the horizontal analysis, they're commonly prepared for both the balance sheet and the income statement, and it compares the percentage change from one year to the next. And the change is the current year. So let's say this is 2023, we'll say, okay, minus 2022 divided by 2022. Okay, so it's always divided by the earliest year. That's the piece you want to remember. And here's an example of this Watkins Glen Harbor Hotel. This is a comparative balance sheet here, and we've got here's our current year, and there's the prior year. And the change is just the difference between the 2 years. And you can see the cash increased quite a bit. Okay, everything here seemed to increase. Other current assets went down a little bit, but generally your assets are almost $1 million higher. Now the percentage change, percentage change in cash, it's 146% positive, but that is the change, 344,740 divided by the 581. That's where the 146 comes from. Okay? And what it shows is that this company really increased its cash position, okay, with an increase of 146%. And also they invested in property, plant, and equipment. You can see that this went up by 26% also. Okay? I wouldn't worry about this. I mean, the percentage change here for the other current assets is large, but it's a small number. It doesn't really matter. Now here is the liability and then stockholders' equity section, and you can see that long-term liabilities increased by 30%. So we had $1,172,000 in, say, long-term bonds or some kind of a long-term debt, and now it's up to $1,529,000. So that's an increase of $357,000. Our debt went up by 30%. Okay, so it's possible that maybe that's how they funded the long-term investments in buildings and equipment, but then it looks like they've got a lot of more cash in too, so maybe they earned more money. We've got to see. Okay, no changes in common stock, but you can see that retained earnings increased by 63%, and that's because the net income for the year was folded into that retained earnings number. Okay, I wish I could see your faces, but remember, this is just an introduction. We'll go over this in class also, and we'll also work some problems. This is just to get you like in the swing of things. Now here's our income statement, and you can see here's a really big change. Our room rental revenue increased by 17%, restaurant revenue increased by 15%, and the banquet revenues went up by 30%. Okay, so our gross profit increased by 17% overall. Okay, that's pretty good. And here are our expenses, but we don't have net income yet. Okay, but increase of gross profit of 17% is really good. And you watch this current year, prior year business, okay, to get this number. Have it make sense to yourself first. Here you can see from the change that the change is positive. So this has to be positive. Okay, that it's larger. So if I take the difference, the 1142,095, and then I would divide it by the prior year, okay, by the earliest period, and that would give me the increase of 17%. Oh, we go on here. Here's the rest of the statement. So you can see advertising went up. They advertised like crazy, 90%. So SG&A increased overall by 14%. Operating income increased by 21%. Okay, we've got some interest here. This is interest income. That's interest expense. Interest expense really went up. We had $22,000 in last year, but this year we've got $131,000. But remember, we had more long-term liabilities, right? But it looks like it paid off because we've earned another $436,000 in net income, and that's an 18% increase overall in net income. So that's what the horizontal analysis tells you. If you're looking at whole numbers here, you're not going to see it the same way. You know, you've got to keep going back and forth and comparing them and trying to see what it means. But if you've already got this all calculated, that tells you quite a bit. So a trend percentage, if you look over multiple years, a trend percentage can show you more easily what's developed over a long period of time. Excuse me. So we'll look at several years compared against a base year. Okay, so we'll take our actual year divided by the base year times 100. So the actual year divided by the base year times 100 gives us the percentage. Okay, and here is our example. Let's see if we can make this bigger. I didn't realize this was so small in here. Okay, so this is a 5-year trend. And these are our numbers from, this is our base. Our base year, say for total room rental, is 4.4 million. Then 4.5, 4.5 went down a little bit, I think. 4.6, the current year is 5.3. Or prior year is 5.3, so there is 6.2. And you can see that these trend percentages increase from 106% to 112, 125, 146. Now this is all divided by that base year right here. So you can see that 106% comes from the current year divided by the base. Okay? And there's the current year, 6505, divided by the base, 518. All right, so this shows it's like a cumulative percentage of an increase, but you can definitely see that that trend is increasing. The trend shows a definite growth in sales over the past 5 years. Okay, we're almost done here. I know it's a PowerPoint, you know, I know they're not the most wonderful things in the world, but it's still a good introduction for you. We won't be doing this in class. Some people learn with PowerPoints, others don't. So, you know, pick your poison and see what works the best. Now let's do a vertical analysis. Now, vertical analysis shows the relationship of each item on the financial statement. Okay, and our base is considered 100%. So everything else is compared to it is the percentage of that base. Now on the balance sheet, the base will be total assets, for example. Okay, on the income statement, it's going to be sales. So let's take a look. Another small thing here. Here is, you can see these in the textbook too if you want to. Here is their balance sheet. And my base is going to be total assets of $35.97, and this tells us that our cash is 16%. Okay, these are pretty minuscule amounts. Inventories are 1.9%. Property, plant, and equipment is 80% of your total assets. Okay, if we look at our liabilities and stockholders' equity, notice that your total liabilities and stockholders' equity is the same as total assets. So all these numbers are reflected as a proportion of liabilities and shareholders' equity as well. Okay, and you can see that the long-term liabilities is really the largest portion, is 42.5%. Our retained earnings is 43%, so that's good. So each account is analyzed as the numerator in a vertical analysis. Okay. And here's a vertical analysis. Here's an income statement. And this is nice. I actually think the balance sheet is a little tricky to interpret with any being sure of what you're seeing. Okay, but the income statement's a different story. Here we've got our total revenues. Total revenues are 100%. That's our largest number on the statement. That's how you can think of it. And we've got three different categories of revenue here. So here's total revenues, 8486. That's 100%. And now we know, we can look at this. 73% comes from room rental, 22% from the restaurant, and banquet 4.4. Okay, now some reason I thought banquet revenues would be higher based on something else we saw. But this really tells you, you know, and then our cost of goods sold is 8.8%. Now this is a nice number to compare from one year to the next to see if your cost of goods sold is increasing as a percentage of total revenue. Okay, and we can see here that salaries and benefits are 30%. Okay, that's our most significant number. Operating income is 46% of total sales revenue, so that's fantastic. Okay, and then we've got some interest and interest expense here that's gone up a little bit probably, and here income taxes are 11.3%, not a small number. Net income then is 34% of total revenues, so that's very successful. Okay, and all the numbers are here. These slides are available in notes also if you want to take a look at them. Okay, I gotta take this down a little bit here. So we prepare common size financial statements by benchmarking performance against competitors or maybe industry averages, because it's one thing to compare yourself to yourself from one year to the next, but your next question would be, well, how do I compare to my neighbor? You know, how do I compare to the industry? Okay, and that would be preparing, doing some benchmarking or some common size statements. Okay, this helps us compare one company against another. Oh boy, that's really small, huh? Sorry. So here is here's the we've got two companies here. Here's Watkins Glen Harbor Hotel. This is who we've been looking at, and here's the Belhurst Castle. And right away you can see that their gross profit is 87% of revenue. Okay, remember that gross profit is going to be revenue minus cost of goods sold is gross profit, right? Really important number. This is 87%, where this is 91%. So in this measure right here is a benchmark. We're doing pretty well. Okay. All right, and then this is let's see. Yeah, they're doing well. Salaries are lower. Okay, that is either a good or a bad thing. It's not always necessarily good, because you don't want to lose your good people. You know, housekeeping supplies. I guess we've got better shampoo. Total SG&A 44%. Here it's 53.9. So this is quite a bit higher. Okay, but the salaries are the big number there. Operating income 46 compared to 33. So, and look at net income, 34% compared to 23%. Okay, this is a boutique hotel that's located in Geneva, New York. And what you want to do, it's larger, it has an on-site restaurant with banquet services, so it's a strong competitor in the Finger Lakes. So is this where Watkins Glen is also. So what you'd want to do is compare yourself to somebody who you think is comparable. Okay, like you wouldn't want to compare this to Trump Tower, for example. Okay, it's the only thing that came into my head. So we want to, pick somebody in a similar location with similar clients, and so we can really just compare numbers and performance. Okay, one more adjustment here. So we use common size statements to compare hotels. The Belhurst Castle has more restaurant business and banquet services, but the Watkins Glen Harbor is managing its costs for food better. Okay, with the cost for food of 8.8% compared to Belhurst Castle 12.6%. But I would want to know something about quality here. Okay, you got to make sure those are really comparable. It's hard to tell. Other costs are fairly similar, with the exception of property and maintenance, which are higher for Belhurst Castle. I think it's closer to New York, right? Oh, I don't know why. And it's actually managing its housekeeping costs and advertising expenses a little bit better. But be careful about cutting advertising. Okay, without any marketing, we're out of business. So those are dollars well spent. And I think that's it. Yeah. Okay.